Hello everybody. Our topic for today is corporate governance and the external auditor. First of all, we have to know what is a corporate governance. Corporate governance is the system of rules, practices, and processes by which a company is directed and controlled. There are 5 basic principles of corporate governance. Number 1, right and equitable treatment of shareholders. Organizations should respect the right of shareholders and help shareholders to exercise those rights. They can help them in exercise their rights openly and effectively communicate their information by participate in general meeting. Number 2, interests of other stakeholders. Organizations should recognize that they have legal, contractual, social, and market-driven obligations to non-shareholder stakeholders, including employees, investors, creditors, suppliers, and customers. Number 3, role and responsibility of the board. The board needs sufficient relevant skills and understanding to review and challenge management performance. It also needs adequate size and appropriate level of independence and commitment. Number 4, integrity and ethical behavior. Integrity should be a fundamental requirement in choosing corporate officers and board members. Organizations should develop a code of conduct for their directors and executives that promotes ethical and responsible decision making. Last but not least, disclosure and transparency. Organizations should clarify and make publicly known the roles and responsibility of board and management to provide stakeholders with a level of accountability. They should also implement procedures to independently verify and safeguard the integrity of the company's financial reporting. Disclosure of material matters concerning the organization should be timely and balanced to ensure that all investors have access to clear, factual information. So now, we look into the importance of corporate governance. Corporate governance shapes the growth and future of capital market and economy. It also helps to protect the interests of shareholders and all other stakeholders. Besides, corporate governance also contributes to the efficiency of the business enterprise. It also acts as an instrument of investor protection, and it helps in the creation of wealth. Corporate governance plays a vital role relating to directors' responsibility. The director must act in the best interest of the company, care and diligence in their function and in dealing with statutory duties. He or she must act honestly and avoid conflict of interest. And must act in accordance to M&A, Companies Act, Securities Industry Act, and comply to the listing requirements. The responsibility of directors in relating to a good corporate governance: he must set a corporate objectives, review and approve and guide corporate strategies and business plan, budgets, and to monitor the implementation. He also has to oversee human resource management. Director must look on how the HRM allocate tasks for the right person and giving them proportionate remuneration and compensation. He also have to develop and implement investor relation programs to effectively communicate with the shareholders, other stakeholders, and the public. Then, director also have to monitor the management of company business and to ensure corporate performance. Audit committee plays an important part in good corporate governance. Audit committee is to assist the board of directors in discharging their duties relating to the company management and internal control, accounting policies, and financial reporting, and line of communication between the board and the auditors. Now we look into the structure of an audit committee. It must be more than 3 members. The director must be an independent director. As for chairman, it must be independent non-executive directors. And then at least one of the member of audit committee is the member of MIA. If not MIA, must have 3 years working experiences and a member of one association of accountant. What is the roles of audit committee? Number 1, to oversight of financial reporting and accounting. Often discuss complex accounting estimates and judgment made by management and the implementation of new accounting principles or regulations. The audit committee interact regularly with senior financial management that is in position to comment on the capabilities of these managers. Number 2, to oversight of the external auditor. It is the changing the external auditor typically also requires audit committee approval. The audit committee also helps to ensure the external auditor is independent, meaning no conflict of interest exists that might interfere with the auditor's ability to issue its opinion on the financial statement. Third, to oversight of risk management. In organization, they have a variety of functions that performs activity to understand and address risks that threaten the achievement of the organization's objective. The policies and practice used by the entity to identify, prioritize, and respond to the risks or opportunities are typically discussed with the audit committee. The audit committee involvement in non-financial risk topics varies significantly by entity. And lastly, monitoring, internal control, and internal audit. Internal control includes the policy and practices used to control the operations, accounting, and regulatory compliance of the entity, while management and both the internal auditing function and external auditors provide reporting to the audit committee regarding the effectiveness and efficiency of internal control. Audit committee also have their own benefits. For the first one, audit committee can strengthening the role of non-executive director. It also can strengthening the objective and credibility of financial reporting, and it helps to improve communication between directors, auditors, and management. The first disadvantages of having an audit committee is interference in which executive decision on operational matters. It may tend to undermine the authority of board and also conflict of mistrust and misunderstanding among the committee, management, internal auditors, and the external auditors. For the second one, audit committee is just a window dressing to comply with Bursa Malaysia listing requirement.